There is no shortage of risks on the horizon. There's a lot of things on investors' mind. What are some ways to balance that risk reward when you're investing?
We talk a lot about diversification, right? There is a fundamental difference between investing for the return you want to get versus investing for the return you need to get.
They're constantly thinking about how much am I going to get out of this? How much can I make? Often not thinking about how much can I lose, chasing the return, forgetting to think about the other side of the coin.
Just remember, dollar cost averaging, rebalancing, stay invested. We're going to have choppy periods, even in the best of times. Building portfolios that you can ride through difficult time makes a lot of sense. Things look really, really good and are set up for 2025.
Welcome to another episode of Wealth Strategies Unleashed. I'm Karen Hyder, and today with me I have
Mike Alexander.
I don't think we've had the opportunity to do a podcast, just you and I, before.
It's exciting for me. I'm glad to be here, and I'm glad we get an opportunity to do this together. So
definitely.
Thanks for having me.
Yeah, this is a perfect episode, too, because today we're going to be talking all about risk. And here is our Chief Investment Officer here at Concenture. This is the perfect topic to be asking you a lot of questions about and diving into. Before we do that, though, you may not be aware, Robert and I typically have a tradition going where I give him my best dad joke each episode. So thought we'd keep that in line and go ahead and do that today. Are you ready for this one?
Lay it on me.
I have to warn you, these are not as good as sometimes I project them to be, but I hope this one can at least make you giggle or laugh. All right, so today's is, why was the stock trader electrocuted?
Tell me, why was the stock trader electrocuted?
Because he shorted Tesla.
You know what?
I gotta laugh at least.
You know what? Actually, if that were the case of late, that would, that actually is a good one for sure.
Thank you. High praise.
The shorting worked earlier in the year, but not as much now.
Absolutely. So with that, let's dive right in. There is no shortage of risks on the horizon. You know, here we are in December. We are a couple weeks away from the new year, 2025. We've just gotten through the election a couple weeks ago. There's a lot of things on investors' minds, and maybe risk is not typically first in mind, but something that every investor should definitely be aware of. So with that, what are some of the risks you see going into 2025 that are top of mind?
Well, I think, clearly 2024 being an election year, there's always some associated risk with any election year. A lot of that has to do with policy initiatives, and anytime there's an announcement of any new initiative, and I think with the the incoming administration, clearly one of the risks is going to be tariffs and the concern around those. But I think if we were to kind of step back and review 2024, even when you don't have any of those things, there's still always risk out in the marketplace, and risk really being more measured by volatility. Mm-hmm. In 2024, we've seen 4 or 5 corrections of 5%. We had a 10% correction, and the reality is you get corrections in the market whether you have something going on to trigger them or not. Sometimes it's just markets become overbought. They move from being overbought to oversold, and back again. And so as we enter 2025, I think some of the risks, if you will, are known. They're the kind of headline type risks associated with discussions around tariffs. Some of it may have to do with geopolitical risk. We've had a couple of wars that have been ongoing for quite some time, and those can always escalate or crop up at any time. Although I think the feeling behind those is that we're hopefully nearing the end of those, and so that would kind of check another one of those boxes that individuals would worry about. Mm-hmm. The other ones I think are maybe working or percolating a little bit underneath the surface, and those would be things like interest rates, more tied to inflation and jobs. And some of the other ones would just have to do with valuations, and that entering 2025, we're not in an environment where risk assets, stocks are cheap.
Mm-hmm. You mentioned interest and inflation rates. Interest rates and inflation, say that differently. Let's dive into that a little bit more. What role do you think interest rates play and inflation both in trying to manage risk for an investor?
Yeah, so it's hard for an investor to really manage manage interest rate risk and manage inflation risk at the same time. But think of it this way, from a diversification standpoint, we typically own a little bit of cash. Why do you own cash? Well, one, it is a volatility reducer. The second reason is that if you were to get a sell-off that represented a buying opportunity, maybe it was one of those 5%, corrections, maybe it was a 10% correction, maybe even more. That extra cash that's sitting on the sidelines would be able to then come in and buy risk assets on sale.
I like the phrase you always say right there too. You always say keeping dry powder on the side for those exact moments.
Yeah, the reality is you never know what the trigger is going to be. Mm-hmm. And we're in an environment where most things don't look, ridiculously expensive, but they don't look dirt cheap either. And so the example there is around earnings periods when companies come out and they announce earnings, and it used to be that you could just look at a company's earnings, or you would get their earnings number, and if they beat whatever the estimates were, the stock would actually rise. These days, that's changed a little bit. Sometimes companies hit on their earnings, but they miss on their revenues. Or sometimes they hit on their earnings and their revenues, and they miss on their guidance going forward. Yep. So there's a lot that comes into play anytime companies are announcing earnings. And so those are the types of things that create volatility. Mm-hmm. And so being diversified in that environment, I think, makes a lot of sense. You asked about interest rates. Well, we've been in a period where since the Federal Reserve cut rates, interest rates have actually gone up. No, not money market rates, not the rate that you're getting on cash, but rates on the longer end of the curve, say going from 2 to 10 years. Those rates have actually gone up. So if you thought, for example, that cutting interest rates meant you were going to get a cheaper mortgage, well, that's not necessarily the case, at least in the interim. And markets are still grappling with that. And so that's one of those risks that's out there, is that interest rates finally begin to rise enough to where it begins to compete with stocks, or especially from a valuation perspective when stocks don't look cheap.
Mm-hmm, absolutely. So with that, how do investors go about preparing for volatility around some of this and all this economic uncertainty that you've just talked about? What should we be doing?
I don't know that it's much around economic uncertainty, but I will say this: there is always, there's going to be headline risk associated with it. The economy seems to be on relatively firm footing. Mm-hmm. Unemployment remains relatively low, and inflation seems to be, at least the rate of change seems to be going in the right direction, right? We still have inflation. We still have prices that have gone up and have stayed stubbornly high. However, the rate of change is actually coming down. And so that's an environment where risk assets should do really, really well. Now, we are in an environment where the U.S. is doing exceedingly well from an economic perspective, and much better than other parts of the globe. So from a diversification standpoint, as you know, and throughout our career, it's always been, be diversified, domestic and international. Well, we're kind of in an environment where the U.S. really is, the one-trick pony, if you will, or has been, or at a minimum, at least it feels like that's been the case. And so I think you want to be diversified across asset classes. One thing to keep in mind is that the large cap space, the mega cap space, some of the big technology names, the largest companies in the world have done extraordinarily well over the last 3 to 5 years. Mm-hmm. And there have been other parts of the market that have kind of been left in the dust a little bit. Some of it would be dividend-paying stocks, but also small and mid caps. So I think from a diversification standpoint, it makes a lot of sense to perhaps be adding to some of those areas. One other thing is that as it relates to the broader portfolios, bonds have underperformed significantly. So you have S&P 500 up 25% plus when bonds are only up 2%. So there's a good chance that a lot of institutions will be rebalancing some of that and maybe come back to owning some fixed income. So there's a variety of things that I think investors can do as we kind of roll through 2025.
So what do you think? What are some ways that an investor could be helping manage the downside risk?
Yeah. So one, we talked about carrying a little bit of cash, and I think part of that has to do with, again, valuations. And, everything certainly looks really, really good. But as we mentioned earlier, you've seen corrections for a variety of reasons. It could be one company misses earnings. It could be one economic report that misses expectations. It could be a Fed speaker that that becomes all of a sudden hawkish out on the speaking circuit. There's a variety of reasons that can trigger that volatility. Staying balanced makes a lot of sense. It would have been very easy for someone to become completely out of balance over the last couple of years, just given how concentrated some of the performance has actually been. 2024 has been better because we've seen the broad indices move a lot, in particular in those small and mid cap areas. But they still have a lot of ground. They have a couple of years worth of ground that they could make up if the market was to continue to broaden. So I think, again, being balanced, making sure that they're checking that stock, bond, cash allocation doesn't mean you have to ignore international or emerging markets. It just means you want to be thoughtful about how you're allocating to some of those areas as well.
What about for investors who either come into some money? We're getting close to the time of year where a lot of people are starting to get bonuses from their jobs. What about with an inflow of cash like that? What are some things that we can be doing to be invested but also help manage some of that downside?
Yeah, the best way to do it is just a dollar cost average, right? I mean, it's something we've done over the years. Is that if you just get a lump sum, you're kind of rolling the dice as to did I get that right? At least on a short term basis. Longer term, it probably doesn't matter necessarily when you buy, but on a short term basis, I don't think anybody wants the sticker shock, if you will, or buyer's remorse of saying, gosh, if I just waited another day or if I'd waited another week or another month or whatever. So I think the best and the most time-tested way of being able to approach that is to just dollar cost average. And maybe I'm going to take 10% a month for 10 months. Maybe I'm going to put 10% over a quarter over a much longer period of time. But I think the idea is just to be a little bit thoughtful and think about how you want to allocate that. Clearly, if you were to receive a lump sum in the middle of a 20% decline in the markets, then maybe it makes sense, to do most of it at that point. But I think the idea is just being a little bit thoughtful. One other thing I think that is worth mentioning is that markets are seasonally strong, typically in that that November to April, May period. And so it's not uncommon for people to get, to fund most of their 401k in the first part of the year. And so it's, if you can be a little thoughtful in terms of spreading that out over the year, even if you're contributing it all in, maybe you're just not contributing at all to equities, but just kind of gradually putting some of that in, because those are seasonally strong periods of time. That wasn't necessarily the case in 2024. We had some really strong summer months, and then we had a decline, and then we had, September and October were actually pretty decent. So you don't always get that, but I think it's another reason why dollar cost averaging makes so much sense.
Absolutely. So I feel like when people hear the word risk, they often assume it's talking about just the downside associated, but we well know that risk can be risk on the upside too. So in terms of balancing the risk reward, I know that this is something you're keenly aware of when you're looking at our client portfolios that you're helping manage, but what are some ways to balance that risk reward when you're investing?
We talk a lot about, diversification, right? It's always about, diversifying across asset classes, whether you own stocks, bonds, cash. I think a lot of that also has to do with diversifying by, in equities, diversifying by sector as well. And that helps to mitigate some of the risk you have. We're in an environment where you have weeks or months or days or whatever the case may be that one sector is broadly outperforming another and another area is just, is not performing at all. And then all of a sudden, for no reason whatsoever, you get some sort of reversal that occurs. And so just being diversified in there. I think the other thing is there is a fundamental difference between investing for the return you want to get versus investing for the return you need to get. And so One of the things I think that we find is that when things are going really, really well, it's like a person can't get enough risk within their portfolio. And then and then all of a sudden when things start to go wrong, it's like, how did I get so much risk in my portfolio?
Yeah.
And so, to your point, people love risk on the upside. They just don't like it on the downside. And I always say it in some cases, it's not absolute risk, right? You own things that they're not going bankrupt. They're not going under. Mm-hmm. It's the volatility of the prices that really causes the issue and makes it harder to hang on to.
Yep.
And so, those are examples. Tesla is always one of the best examples. For some reason, all of a sudden the company misses its earnings. The stock goes under $200. A share goes down to $100 a share, and then you fast forward, and the next thing you know, it's $350. And there hasn't really been anything fundamentally that's changed about the company. They're still manufacturing batteries and making cars. Whether they're hitting delivery numbers or not, it's just the sentiment.
You made a solid point, too. It feels like and it seems like when people think about risk, they're constantly thinking about how much am I going to get out of this? What's the upside to this? How much can I make? Mm-hmm. They're often not thinking about the flip side of that. How much can I lose? Am I okay with that amount of risk that I'm taking? People are often chasing the return, forgetting to think about the other side of the coin.
Yeah, it always pays to have, some sort of sell discipline associated with it. And clearly there are companies that you can make the case that there was never a time to sell them. Mm-hmm. They've been around for so long that anytime all they did was move on to a higher price later on down the line. But I think the idea is to have that sell discipline that says, look, I can't sleep well at night. And if you can't sleep well at night, it's probably not something that you want to own. From
a stability and from a growth perspective, kind of talk to us about what your thoughts between allocating from cash, stocks, bonds, all across the asset classes. What are your views there?
Yeah. So I think within stocks, I think you can think about market capitalization again, large, mid, and small. But I think you can also think growth and value as well. The name of the game in the last several years has clearly been on the growth side. Mm-hmm. And so one distinction I would make is that and this seems somewhat contrary in terms of the way that you think about it, but in the absence of growth, so when there's not a lot of growth out there, people will pay more for stocks that are growing. So with the change of the administration, there's clearly been this thought that we are entering now back into a more pro-growth environment. That doesn't necessarily mean pro-growth in terms of stocks, but pro-growth in terms of economy, which should mean, right, that you begin to see some broadening of the economy, meaning that growth becomes less scarce. Okay, there's more growth out there. And if that's the case, then some of the names that we used to call value names should perform a little bit better. Now, that will vary by sector because, we have a lot of things going on underneath the hood, if you will. But you in a healthy market, we would start to see some broadening of that. And we've seen some of it, in the last part of 2024, whereas for 2023 and the first part of 2024, it was all growth. It was all Magnificent Seven. Those were the stocks that you had to own. And by the way, you didn't want to own any bonds because interest rates were rising, right? And so not an easy area. I think now that rates have risen a little bit, now, all of a sudden cash is still paying you something. Bonds now are paying you some, they're paying you something as well, and you've got broader participation in the market. So that's not to say that those things can't change on a dime, but things look really, really good and are set up for 2025 in a positive way. You always have to caveat them and say, look, there's always something geopolitically that could happen. There's always something that could happen on the trade front or what have you that could disrupt that. But for the time being, we seem to have a tailwind in place. How much of that's priced in, as of today is anyone's guess, but there's still a lot of cash on the sidelines that could be committed.
So I feel like we've covered a lot. We've talked about the economy. We've talked about geopolitical risk, investment risk, inflation, interest rates. Is there anything else that we need to be aware of or be thinking about in terms of risk itself, managing it in our portfolios, anything along that line?
Just remember, dollar cost averaging, rebalancing. From time to time, it's prudent to always go back and rebalance portfolios. And I think stay invested. Things are going to be, we're going to have choppy periods, even in the best of times. And staying invested and building portfolios that you can ride through a difficult time, I think makes a lot of sense.
Awesome. Mike, thanks so much for joining us today. This has
Thank
been
you for having
great.
me.
Thanks, listeners, for following along. Don't forget to give us a follow, and hope to see you guys next week.
The information contained herein is intended to be used for educational purposes only and is not exhaustive. Diversification and/or any strategy that may be discussed does not guarantee against investable losses, but are intended to help manage risk and return. If applicable, historical discussions and/or opinions are not predictive of future events. The content is presented in good faith and has been drawn from sources believable to be reliable. The content is not intended to be legal, tax, or financial advice. Please consult a legal, tax, or financial professional for information specific to your individual situation.
This work is powered by Concenture Wealth Management, registered representative of Sanctuary Securities, Inc., an investment advisor of Sanctuary Advisors, LLC. Securities offered through Sanctuary Securities, Inc., member FINRA, SIPC. Advisor services offered through Sanctuary Advisors, LLC, an SEC-registered investment advisor. Concenture Wealth Management is a DBA of Sanctuary Securities, Inc. and Sanctuary Advisors, LLC.